Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 104. As always, joined by the three amigos. We've got Keith Dicker, IceCap Asset Management, in his new Patagucci vest. Rich Diaz, Tom Brady of Macro in Montreal. Welcome back to the show, gentlemen. Keith.
Hey, good morning, everyone. So this is the big episode. You guys missed the conversation or the very poorly calculated math problem we try to do here. We're trying to figure out if this was our second anniversary episode or not. And what did you conclude, Rich?
It is. 52 times 2 is in fact 104 and not 204, Keith.
So that's 2 years, guys. We want to put a very sincere thank you for everyone to tuning in every week. I think everyone knows now, three of us, we have a ball doing this all the time. There is some real genuine love between all of us here, and I love it. I look forward to it. So it's been good. So we'll have to talk later on this episode whether the government will allow us to continue, because that was big news this week. But what else?
Don't say anything bad.
Unacceptable views.
It's only bad if they deem it to be bad. So we don't know. Yeah, we don't.
But it is little, give ourselves a pat on the back here. We haven't missed a week, in 2 years, through thick and thin, traveling the world. Boomer's been all over the place. Rich, you've been Halifax, UK, Montreal, Portugal. You guys joined me on my honeymoon last year. We've been all over the world filming this podcast. So yeah, 2 years straight, and I wouldn't change a thing.
I'm sure your wife really enjoyed us joining on your honeymoon.
Yeah, she knows the priorities. So
that's right.
Loonie Hour comes first, right, Boomer?
Except for for this week, everyone knows the story that we record on Thursdays and this is released on Fridays, but we've thrown everyone for a loop this week. Today is Wednesday, so you're getting it on a Thursday.
Oh crap! I have to go. No, I'm kidding.
No, I'm the one traveling. I'm traveling here in a little bit, and so it just didn't make sense for us to do it. Anyway, guys, let's get on here. 2 years are done. That's the past. We're forward looking, and I have to tell you, everything that's been happening in the last week. Again, it's just been outstanding for what I'm seeing, and I'm sure Steve, you and Rich are seeing the same thing as well.
Yeah, I think there's a really important asterisk here, obviously, that we're recording on Wednesday, and these markets seem to be fluctuating every day in a meaningful way. So, if you're listening to this episode on Friday and we missed some big news on Thursday, you can blame Keith, who's traveling to San Fran to watch the big game. We're gonna get into the predictions too.
It's at the end, of course, of the episode. Yeah, there's really 5 guys are interested in that, so you keep them on till the end.
Yeah, the cliffhanger.
Yeah, out to the Bay Area, a couple of meetings, and then have a bit of fun at the same time.
Yeah, no, it's good. Well, we do have some updates here on the housing file. Obviously, Vancouver and Toronto. Everyone was kind of waiting for the September numbers, because I think, as we talked about several episodes ago, right, which was you can't really gauge the health or strength of a housing market in the summer months. It's just a seasonally slower time of the year. There's not usually a lot of inventory. So September is typically like your uptick, your fall market, September, October. And so, this is kind of like the first real test, I think, for the housing market in quite some time. And so we did get some numbers out of Vancouver and Toronto. So in Toronto, home prices dropped again for the second consecutive time. New listings were up 11% on a year-over-year basis. So benchmark price of a home in Toronto dropped 0.8% in September, following a 0.2% decline the previous month. So Toronto is slowing. September sales were really weak. I just had a good conversation with John Pasalis, who's, I do a monthly show with him. So we just recorded that yesterday, but just chatting with him, like anecdotally, what's happening over there. Things are slowing really sharply. Showing activity is down. Prices are coming off. It's probably not the full-on panic that, you read about on Twitter, but it's a market that I would say is definitely softer than Vancouver. But Vancouver.
Steve, so what's the local reaction? So are people, still in that mad rush to buy, but they're being a little bit hesitant about it? Or are people who want to sell, are they the ones who are nervous? Like, is there any reaction at all yet?
I think that people that have been buying, even in September, right? Like, this is the thing. Like, people that were buying in September, a lot of them are still buying on like old rate holds, right? So I got a client right now that's got a rate hold at 5.1% that expires in 3 weeks.
Wait, what do you mean? They're porting their mortgage? You mean?
No, so like when you go to like a mortgage broker or bank, they'll give you when you first submit your application, they'll give you a rate hold. So they'll say, you're pre-approved, and we're going to hold this rate for you for, usually it's 120 days, depending on the lender. So they'll hold it. So like, we can guarantee you this rate, no matter what happens in the bond market, you get this rate for, you got 120 days to find something and close on it in 120 days. So there's still people that are transacting. Keep in mind, the sales volumes are really weak, but people are still transacting at rate holds of like 5, 5.1, 5.3, 5.5. And I can tell you, like, the new rate today is about, 3-year fixed mortgage rate's going to be like 6.3, 6.4. So, I would argue that.
So why don't you share with us what would be the change in a mortgage payment for, say, someone borrowing $1 million, just to keep it round?
Man, you're really putting me on the spot here. I can tell you if I run some quick math on this. So.
Keith, I thought you were the one who was good at math. Remember episode
I know.
204.
I keep telling everyone I'm actually good with math. That's what I'll say.
Yeah,
that's twice now I've concluded I'm maybe not as sharp.
So let's keep the numbers like relatively clean and simple. So let's just say you were going to borrow $1 million on a 30-year amortization, and you got a rate hold at 5.2%. Your mortgage payment is $54.57. And now the new rate, let's say 6.2. $6,074. So what is that?
Here's my math. $1,300 more.
Yeah, so we'll call it an extra $600.
Right, Rich? Did you like that, Rich? Hey, thanks. Yeah. See?
Yeah, $600 a month for basically, let's call it a 3-year term, right? So if you don't get that transaction, and now again, I know the flip side of it is, well, why don't these people wait? Of course, prices are going to come down, but like I would argue that a lot of people don't necessarily live their life in a spreadsheet. Like, a lot of people are just like, I want a family home, and prices probably might come down. But I'm going to live here for the next 8 or 9 years. And my wife wants our kid to be in this neighborhood so they can start school and build a community. Like, that's how most people live.
Steve, I have a question. What is the single busiest month for real estate? I can't believe we've never, in 2 years, I can't believe I've never asked that question.
March or April.
March or April. So the spring.
Spring market's the busiest, but I would say fall is like the second busiest, right? So September and October are like pretty good tests for the market.
Okay.
Now, switching gears to Vancouver, I'll give you guys a quick update. Sales were weak. Down 13%, or sorry, they're actually up 13% year over year. So people might get a little bit confused, but if you actually look at September of last year, it was like outside of like September of like 2008, which was like literally the global financial crisis. Like, it was like the worst September in 20 years. So naturally, like, on, again, base effects, everybody's learning about, sales are up 13%, but they're still like 25% below long-term averages. What is interesting is that new listings have finally, I think this is like the big thing to keep an eye on moving forward, is like new listings were finally back to like normal levels. In fact, they were like slightly above their long-term average, which is like, for a good chunk of the last year, new listings have been hovering at like 10, 15, 20-year lows. for many, many months. And that's really supported prices despite mortgage rates moving higher. And so finally here in September, we finally got new listings back to really historical norms, and sales were really weak. So inventory is now going to slowly start to build coming off a record low base, but I do think that's going to be a headwind here for the back half of this year. So
do you think that's when prices continue to sort of gap down again now that there's more inventory?
Yes, but I still would like on an absolute level, like inventory levels are still really low.
Okay.
But just demand is so bad that like prices are coming off a bit right now. And I think that's going to continue in the back half of this year. I mean, like I said, you got mortgage rates stuck in the 6s, and hard to see how that's going to change in a material fashion over the next 2-3 months.
So what are the four, like, so I'm thinking like there's 4 different pieces all pulling at the price together, where you got the rates, you got the inventory, you've got demand, and then I guess that's it, and then you've got just like, I guess, the supply of new homes, right? Those are the like sort of the 4 different things that.
Yeah, supply of new homes I don't think is like that big of a deal here.
Okay.
I just think it really comes down to interest rates, what people can qualify for. At 6.3, you're stress tested at 8.3. OSFI is expected to come out with some announcements and I think later this month or early November. So I think the regulators, actually the OSFI was out talking about some concerns in the commercial real estate market. So I think OSFI right now, like that Peter Rutledge guy, has got to be working around the clock. I think he's probably shitting bricks. Like he's gonna be a busy guy.
Do you have any views on commercial real estate, or
not really?
I mean, okay,
Keith does.
Keith does. I'm sure. Come on, Keith.
Give us the
I have
dirt.
a view on everything. I do know it's something that you guys just didn't discuss that might affect real estate market a little bit differently than just supply and everything. That is that us not achieving a soft landing. It's getting a bit slippery out there, everyone.
Yeah.
Should we?
Someone lubed up the runway.
Yeah, some data just came out in the US that it's not so hot.
Yeah, it's different though. I mean, we'll go through all that, but I again, like you guys are too young to realize that the economic cycle does produce a recession every now and then, and we're gonna have one. And if it's harder than what everyone is talking about, that demand side for real estate, so supply may not go up too much, Steve.
Yeah.
But the demand side could just fall off a cliff here. Or alternatively, commercial banks raise up mortgage rate because they have to. They're concerned about losses. Yeah.
I would argue that, and again, I'm not saying it can't get worse, but the demand side is really bad right now. Like, if you look at sales volumes.
So if it's really bad, I'm just suggesting it might get really, really.
Yeah, fair enough. Like sales,
so that's
sales
3
volumes.
Reallys. Rich, if on a math scale, 1 really versus 3 reallys, how do you quantify it?
Oh God, I don't know.
So I don't have the exact figures in like Toronto, right? But like I said, Vancouver, so sales are 25% below the 20-year average for September. Now think about how many like population growth over the last 20 years. Like demand is really weak. And I think, like I said, inventory is still low on an absolute level. And so if inventory builds, which I think it will over the next several months, but I think like one thing to keep in mind for people is like real estate is, especially residential side, is really slow moving. I mean, you're seeing it in the commercial side, right? Like there hasn't really been a lot of price discovery. Everybody's just
putting it mildly, mate.
Yeah, everybody's like sitting on these assets. Nobody wants to reprice it. Everybody knows cap rates need to go higher. But like there's just like commercial real estate's gone no bid. Residential sellers are digging their heels in, and everybody.
The great thing though about commercial real estate, the institutions who own it, like pension funds and stuff, they never have to market anyway. So it could just sit there for a long time and until it doesn't.
Is that what they're doing with their bond holdings too?
Oh man, you said, did you say shit show earlier? Is that what you said? Is
Yeah,
that the expression
Peter shitting bricks.
This is a kid show. This is a kid show. Shame on you guys. This is a kid show.
It's 2 years of poo talk going on. Yeah, because there a few months ago we talked about the private lending market, private loans that's going out there, and BlackRock, of course. When BlackRock releases a fund of some sort for something, it's the top or the bottom of the market, depending on which way you're looking at it. But the way the fixed income works, for over a decade, we had no price discovery. I love that expression, by the way, Steve, you brought it up. We had no price discovery in the bond world. And so because we had zero rates, and low next to zero, it just forced every single bond manager out there to sell government debt, buy corporate debt, buy high yield debt, buy emerging market debt, buy preferred shares, debt on debt on debt, and then private loans, like anything to maximize yield, because it never had to be marked. You didn't have to worry about it. But now they are starting to be worried. I think it's, I think things could turn here. Maybe we've, hope is never a great strategy, but I think the hope is that maybe things stabilize a bit. But if not, it could be a bit concerning.
What was like the top of the bond market? Wasn't it was it Austria? Who was selling 100-year bonds?
Austria. It was Austria. 100-year bonds, zero coupon. It was a food fight to get them too.
So a couple of years ago, we had an opportunity to short that in, not for the Canadian portfolios to manage, it was something else we do. And the broker came back and they located, the shares for us, or whatever you want to call it in the bond world. They said, yeah, we have it here for you if you want to short it. So shorting, people don't realize this, but if you're shorting shares of IBM or something like that, it's not a big deal, because you can always, because what happens, like if I'm shorting it, Steve will lend me the shares and I sell them to Rich, because Rich is a sucker, right? He's going to buy them. and then at some point, Steve's going to come back to me and say, hey, Keith, I want those shares back. And I go back to Rich, and Rich still holds them, so it's easy for me to buy them from Rich, or just buy them for the market, right? Because they're shares of IBM. In the bond world, a lot of bonds are just not liquid. The pension funds buy them and tuck away, and you can never find them again until they mature. So with this Austrian bond, the exercise we went through, we said, okay, we can borrow these shares. Someone's willing to lend them to us, and then we'll quickly sell them to somebody else. But if the person who lent them to us comes back and says, hey, we want our shares back, then we have to go out and be the buyer. And so you might be short a market in the bond world. And if it is in a liquid market, you could get caught in another poo analogy, I guess, if you want to go with. We got to change it up. We got to change this up.
Well, let me help with this a little bit.
But I'm not finished with the Austrian bond. It turned out that would have been, like, if you shorted the Austrian bond at issuance, or about a year after, or 6 months, I think it traded up close to, maybe, I'm guessing now, 160.
140. I'm looking at it right now.
Was it 140?
Yeah, it went up to 140.
Where's it trading now, Rich? At what level?
34.
34. Man, talk about, like, you would have made about 4x on your trade.
And there's zero coupon on that bad boy.
No, I lied. So that's where I wanted to correct myself. It was 85 basis points. So less than 1% coupon on a 100-year bond.
And inflation's at like 4% annualized.
So guess who was the big winner? Guess who was the big winner on that transaction?
The Austrian government.
Of course,
it was a brilliant trade. It was a brilliant trade.
Only in Canada, we had a government that would have went out and borrowed. They could have borrowed $1 trillion at 0% for 100 years.
Yes, it was oversubscribed. So that's the other thing. We always talk about people sort of pitching to purchase that stock. So they received something like 16 billion euros worth of orders. Not that much money, but the point is that there was appetite for this product. And as you said, Steve, our dear leaders could have at least extended the maturity past 2 years.
Who's the bond trader at the desk there?
Hey guys, the trader does execution only, usually, not the management side. So don't blame the trader. However, the great thing,
blame the Russians.
Yes, disinformation.
Oh God.
blah, 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 blah. Blame the Russians. But the great thing about the Austrian 100-year bond issuance for Canada is that Austria is not a member of the G7, so it still makes us look okay on a lot of metrics. By the way, Rich is giggling all the time here. If you can see him.
It's just funny.
Rich.
It's just funny because it's tragic. That's why. Honestly, I laugh
And
because
true.
or else if I don't laugh, I'll cry. It's funny and true. Yeah, sorry,
Rich,
Steve.
when you were running the big boys there at Acorn Macro, you did point out a lot of the government's inability to lock in cheap long-term debt. And so a lot of our debt issuance during the pandemic there, our spending spree was actually a shorter duration. I don't know if this is this is posted on Twitter here by Hanif Bayat, who runs that site wawa.ca. So they're pretty big there. But he I don't know if his math is necessarily correct, but he says over the last 4 months from April to July of 2023, government revenue has been $146 billion. Interest payments have been $14.5 billion. So he's saying 10% debt service ratio. So it says soon enough, over 11% of our taxes will be used for government debt interest payments because the 5-year bond he's noting is obviously surged to almost 4.5%.
Yeah, I mean that was the problem. So when there was lots of debt issued, again, right or wrong, let's move past that. The point is when all that debt was issued, it was issued on a very, very short duration. Now people say, well, it's not fair. How can you say that? Well, number one, there's two things. One, when the world was caving in on itself, yes, central bankers were buying lots of bonds to depress interest rates, but so was everybody else when they sold the S&P 500 and they were worried about a zombie apocalypse. There was loads and loads of appetite for bonds. Case in point, people buying an 85 basis point 100-year Austrian bond. And so they could have pushed out that maturity much, much further. Let's say maybe not to 100 years, but certainly past 2 or 5 or whatever it was. I think, do you remember the number, Steve? I mean, it's been 2 years since we talked about it, but I think it was like 67% of all the debt was issued below 3 years or something like that. I mean, it was a horrific,
you gotta pull up the old
number.
chart deck there, buddy.
Yeah, I don't have it anymore. I work for PGM Global, which is an excellent company. Free plug. But the point really is that. Go ahead. Sorry, Keith.
Something just to share with people. People might say, "Well, why the hell would you buy a 100-year bond paying out 80 basis points?" Just remember that the world really is broken down between institutional investors, like the really big gobs of money, and then the rest of us. The rest of us, we'll trade it. We don't live forever like a pension fund, and we're sensitive to losses and things like that. But the attractiveness of a 100-year bond for a pension fund, it's extremely attractive because they don't really care about the yield on it too much. Because one thing with a pension fund, they really have two pools to look at. Okay, two buckets. One is the assets that's in the pension fund itself, and one is the liabilities. So when you have a 100-year bond, the duration for that is a great offset to liabilities that the pension might have as well. So that may not mean much to some of you listening, but just to share with you, pension funds are pretty smart, and so they didn't make a total dumb trade on it. But the new theme, math is the math on this episode, and it certainly comes back to, as the issuer of the debt, Austria was quite smart to do that.
Keith, what else have you been flagging? We've obviously got some, we've talked about this bond market volatility. You would think, it's interesting, right? Because it's like bond market, yields are pushing higher and higher and higher, seemingly every day. Yet I would argue, Rich might disagree, but the economic data doesn't really look that great. Canada's PMI, laid another one in the diaper there.
That's the theme of the show.
Oh dear. Yeah. But we've been talking now for maybe 2 years that the economy may eventually slow down. 2 years, of course. But we're now starting to get the confirmation that it is happening. And remember recently we talked about financial markets. They were hoping and waiting for central banks to stop raising rates. And every time we got a bit of soft economic data or softer inflation data or on the growth side, whatever, the markets cheered, and the stock market went up and all that stuff was going on because nobody wants higher rates. But we also commented that at some point that is going to turn, in that bad economic data is going to start to be seen as, oh wow, we were closer to a recession. And then the conversation comes to, is it going to be a soft landing or a hard landing or stagflation?
No
all
landing.
these different things.
Or no landing. Remember that?
Yeah. But I think that's long gone. But so that's what's happening now. So we're starting to see, some pretty soft data out there. And, the last couple of weeks, especially, things are starting to sell off. What's interesting, I came across this, article, I think it was a Bloomberg one, and it talked about the number of times soft landing has been researched in newspapers over the last week or 2 weeks, whatever. It was pretty high. Then it showed economists' estimates leading into the last 4 recessions. So it goes back to the 90s, right? Early, the first recession, 1991. And each of those 4 recessions we had, right up to the most recent one, economists as a whole, they all missed it. And they're all predicting a soft landing at that time. And the reason why they missed it, because all the, the economists, again, as a consensus as a whole, there are some, individual ones who would predict it and everything, but they effectively say, we just see the world in a normal economic cycle, in that we don't anticipate, these extreme events or fat tail events. And boy, they happen all the time. Fat tail events happen all the time. So if we do get a bit of a not soft landing or hard landing, it's going to distort a lot of capital out there that hasn't, priced in this the least bit. So that's why we're getting all this nervousness right now with markets are coming off. And, we kind of like it because we prefer to buy low and sell high. Right, Rich?
Yeah. Well, Steve, you mentioned... I think so. I think that was like CFA level 1. But Steve, you said you're talking about was it bond volatility you were mentioning? And there's different ways to measure that bond volatility. There's something called the MOVE index, which is rather famous. But we also talk about, but what I think is interesting is the equity volatility has also caught up. First, well, not in absolute terms, but definitely sort of directionally. And how you measure that is something called the CBOE VIX index. So I think it's the Chicago Board of Exchange. Yes, I think I got that right. And that CBOE index basically there's different VIX. There's something called the VDAX, which is based on the DAX, which is the German stock market. And the VIX is based on the S&P 500. And they use basically options and the price of options to sort of assess the volatility or the movements intraday or I guess you could do it per minute, whatever, of what's going on in the market. And so for the last couple of years, people have talked about the dislocation between the volatility of bonds and stocks. And that's fair enough, but I think that's sort of misses the trick. I think what's more interesting now is that over the last month, you've seen the VIX jump from, let's say, a 13, which is relatively low historically, all the way to 18, 19. So that doesn't sound like a lot, but what's interesting is that's moving along with the bond and the bond volatility as well. So those things are just moving together. And so you're basically losing money on bonds and you're losing money on stocks. So
Which is a really good point, because we've been taught that you have this balanced fund mandate.
Yeah.
If the stocks do poorly, the bonds will hold it up, and if bonds are doing poorly, then stocks will hold that up and everything. Yeah, we get both of them are.
Yep, that's only true in a world where you have interest rates go from 20% to 0 in a straight line, right, Keith? Like, it's in a world of falling interest rates that works.
If only people could produce a long-term chart on something, they would see it.
Speaking of the some of the data, Rich, I was kind of curious your thoughts on this, because I think it was today. So we've had this huge movement in the bond market, over the last week or two. I think Canada had the national holiday there on Monday. And so obviously, the bonds weren't trading on Monday, but I think we opened up Tuesday and the Canada 5-year bond was up 25 basis points, which is absolutely, that's nuts.
That's incredible. I wonder how many times it's happened. And sorry, keep going,
Keith. That's got to be a multi-standard deviation move.
It's pretty unusual, and it's happening across the curve. So again, I think everyone understands by now that these rate movements we're seeing, not necessarily. So remember, the Bank of Canada hasn't hiked now for how long? Pull it up. When's the last time they hiked?
June,
2 months ago,
hiked in the
June or
summer.
something.
Yeah,
and they paused before that as well. So is it 2 hikes this year?
They did 2 this
God.
year. Yeah, they unpaused in the summer, I think, and they got 2. I think they sneaked 2 in the summer.
Yeah, remember it was the unpause.
They unpause.
Unpause. I thought you called it something else.
He panicked after the spring
the
market.
Pregnant panic. It was the panic pause.
The panic, yeah, or the panic hike and all that stuff. Now I can't remember where I was going, but I do actually. Yeah.
Do you have
so the point is that we haven't had a lot of movement on short-term rates. Remember, that's where all the movement was. And now the rest of the yield curve is starting to catch up with it. And
well, I was going to say, I'll chime in there because it's interesting. Like, what we're actually seeing now is they actually seeing because of what you just described, right? So fixed rates are like ripping, and the shorter end, like, on like, so people are going. There's a lot more people now slowly starting to tip their toes into the variable mortgage product once again after being completely scarred over the last 18 months. People are now looking at it and saying, okay, the Bank of Canada's maybe done. Maybe one more hike is kind of what the market's priced in. And they're expecting, I think, 1 or 2 cuts next year. Like, again, this can change, but this is what the market is pricing. And so you're actually starting to see people saying, okay, well, maybe I should go with a variable as opposed to locking in at, 18-year highs or whatever on your fixed rate.
Yeah, and I don't know the answer to that because we do not provide investment mortgage advice.
What is the Keith? Do you have it on your Bloom tubes though? I am curious if the rate hike expectations have shifted at all. Because I would argue that if I'm Tiff Macklem sitting in the chair at the BOC, I have to be looking at the bond market and saying, this is kind of doing the job for me.
I don't have it. I think Rich has it up there, don't you, Rich?
I do. You have to stall while I type.
His computer is going to crash.
Oh no! I think you're right.
Computer's behaving today.
They are finally getting some help from the market itself. And just remind everyone, the only way the Bank of Canada can really achieve their objective is to punish grocery stores for selling food. No, that's not the answer, is it? We're really going to get shut down here. But and this is sincere and truthful. The only way for central banks to really bring inflation down is to crush the economy. And it doesn't sound nice. It is not pleasant at all, but you have to crush demand. That's it. Or they can just start building manufacturing plants for everything, everywhere, and get the supply chain moving. But that ain't going to happen. So they're secretly hoping for a non-soft landing. And if we get it, I hope you're ready for it. Are you ready for it, Steve?
I got my tinfoil hat on. No, I'm ready.
Well, I mean, it's actually funny. So
Keith, I agree with you 100%, by the way.
Why is that a tinfoil hat?
I was just bugging you. I'm just bugging you.
No, they're bugging me. Thank you for that, boys. But no, just what's funny is actually there's still, some smidge of interest rate hike priced in the market. So I'm looking at, the famous WERP, if you've got a Bloomberg machine, and it says 25% chance of a rate hike by December.
Well, so that's pretty low, though.
I know. It's obviously fallen. Remember, I think it was up to 50% a little while ago. So there's your answer, Steve. It's come down quite a bit.
So that's probably a 1 in 4 chance, something maybe, right?
It's not nothing.
Not nothing. And then they got a couple cuts priced in for next year still?
No, not on mine. And there's still hikes technically priced in. So let's just say no cuts until November of 2024.
There you go.
And by the way, you could actually have central banks right now, like the Americans especially. They could be thinking, you know what, we need to do one more here, or maybe 2 or 1 and stay hawkish, and that will do the trick. So maybe
it's not a bad point. Just put your foot.
Do you remember what my strategy would have been a year ago? Do you remember what I said I would have done?
Hope.
No. I would have hiked rates by 100 or 200 points. Just do it just like that and
crush them like ants.
Well, actually, I mean, I like ants, so let's not crush them. But one thing I think is important to, I think, is just, seeing as it's our second anniversary.
Just wait a second. You like ants? Is that what
do you do
have a conversation with your dates about?
Ants are
my
amazing.
name's Rich. My name is Rich. I like ants. What do you think? Yeah, I think I'm out of here.
Ants can lift like multiples of their body weight easily with their pincers. They're amazing creatures. Come on.
We're talking about Rich's bench press again.
No. Are they called pinchers or do they have legs?
Pincers. Pincer with this. Well, they have little legs. They have 6 legs and they have pincers.
It's amazing. That's amazing.
Big ant guy.
No, it's amazing that you're actually talking about it, not that they can do these.
But anyway,
2 years, guys. We achieved 2 years talking about this stuff.
Oh yeah, that's it. So what I want to say was we talked about when interest rates were very, very low, and there was like something called forward guidance, and what they did was they browbeat and bullied the long end of the curve to come down. So it means long-term interest rates needed to come down towards, let's just say, 0 for argument's sake. I think they bottomed at like 50 basis points. And there was a lot of, we're never going to raise interest rates again. We're never going to raise interest rates again. But they obviously got that wrong. Thank you, Tiff. But the key thing I think we're seeing now, and what I will say, we said this like maybe 6 months ago, is I think the opposite is now happening. And I think it was, and maybe the market is finally getting its head wrapped around it. And maybe that's what we're seeing, where we saw it started with Jackson Hole last summer, if I'm not mistaken, Keith, when he was like, listen, kids, you're not understanding. We are going to raise interest rates and we're going to keep them high and bring them a lot. And I think it was bad. Remember, you said it was like a 2-minute speech. It was very, very short. And I think it happened again just a couple of weeks ago where, and I think given the relative strength in the US, given obviously the stickiness of inflation, thanks again, Tiff, we know that's what the market's obviously pricing in. The other thing I think we don't talk enough about is the fact that the US budget deficit is 8.4% of GDP. I mean, maybe it's off slightly than that, but it's just the incredible amount of debts and how, that's until you get the governments to sort of rein in their spending. Forget Canada for a second, whether it's Italy that just, spooked the market with their budget deficits. The UK there's no appetite for austerity in the UK either. The US that's a joke. 8.4% is ridiculous. I don't care how many semiconductor factories you're building or what have you. And so until you get those governments to start reining in their spending, there's a case that you're going to see these interest rates go higher and higher. And it'll be interesting to see how that all squares out.
Didn't Italy just vote in some like pretty far right?
Anybody who's
is that just the media right, painting it as far? Yes. Okay, yeah, classic.
Yeah, I'm not saying she's good or bad or whatever. I mean, she made her bank tax was absolutely ridiculous. So like she's made a couple of fumbles, but not everybody is far right. I think that's
I don't really get any media sources anymore. It's hard to find these days.
Yeah, you need a VPN. But I don't
know. I think Rich, I was also going to ask you on the so on the data front, is there anything that can start to
there's loads
to change the outlook of the bond market? I mean, this is kind of a runaway freight train. We did get some data. So we had JOLTS yesterday. Mm-hmm. We had ADP data in the US today. The ADP data was pretty weak, was it not?
The ADP data was weak. You have to be careful with ADP because it's always a bit. It's not the one that we really sort of hang our hopes on. The non-farm payrolls that comes out on the first Friday of every month, and that's in 2 days from now. There's my math skills for you, Keith. That comes out on, and we'll see. I mean, that'll be very, very important. The JOLTS.
What is the expectations for Friday?
Hold on. It's coming.
3, 2, 1.
The JOLTS for Friday non-farm payrolls. Change in non-farm payrolls is 155. It's actually quite low.
155. So if you're listening to this Friday, you will probably have the number 155.
And that's the expectations. We'll see. The other thing that comes out on Friday is very important, which is obviously the change in manufacturing payrolls. So we've gotten actually decent manufacturing data, whether it was the durable goods orders, the factory orders were okay. The PMIs have actually done decently well. You could argue that there's like an inventory restocking portion of that. The other stuff that comes out on Friday for the US is average hourly earnings. Participation rates are very, very important. So it's not just important to look at the unemployment rate, but the labor force, who's entering or exiting the labor force. Obviously, wage growth is key. But back to your JOLTS thing, Steve, I think it jumped a lot, but I think you have to be really careful because that series is extremely volatile. So what I mean by that is that it actually bounces a lot, even though it is technically seasonally adjusted. There's still a lot of volatility in that series. So I never
Can I give
never
you one?
pin a tweet on one data point is what I would say. Yeah, go ahead. And I got a couple others, but go ahead.
Keith, I'm gonna get this guy going. Watch this. So according to the ADP, professional and business services jobs plunged 32,000. But JOLTS reported yesterday a 509,000 increase in professional and business service job openings. So again, I don't know what's going on here.
So that's a really, really good point that you make. And I would definitely fade that JOLTS opening. And you say, Richard, why? Well, just a few minutes ago, the services PMI came out and the employment component, remember in the diffusion index, my favorite pickup line of the 2 years, there's different components. There's like new orders, there's export orders, there's prices paid, inventory, et cetera, et cetera. And one of them was obviously employment. Are you hiring or firing people? And then new orders also absolutely cratered. So I haven't looked at the details quite just yet.
Which data set is this? Sorry.
That's the ISM non-manufacturing. So in parentheses, services, PMI, purchasing managers index.
And that
so
was,
that's
what did that come in at?
Came out. Yeah, it came in at, it's still positive, 53.6. So still in expansionary territory. Came in better than expected. It's above 50, right? 50 is your expansion decline line. So we'll see. And remember, service is a much larger portion of the economy. But one last thing, and I'll pass it on, which is so on that JOLTS figure, you have the job openings by region, and you have it by sort of employment type. So along with the business professionals, you might have whatever truckers. The thing that I keep interested in, something actually my colleague pointed out, which is, the lower income jobs that had seen so much wage growth and seen so much sort of appetite for those have actually really started to like go down. So the retail sales stuff, like anybody works in the retailing and all those kind of similar type of jobs, of those opportunities are really, really diminishing. And we mentioned this a couple of weeks ago, which is the temporary service employment, which is usually a leading indicator on the labor market. That's also started to continue to fall. So Keith, there you go. There's your roundup there for a little bit of the data. Maybe we should talk about the Canadian data.
So Rich, what's your summary? The labor market.
Are you finished now? I was kind of resting with all that.
What's your summary though? Basically, you're starting to see cracks in the labor market.
Yeah, that's been true for a while, but it takes a long time. Here you go. Here's another one for you, Keith.
It's almost like house sellers trying to reduce their price.
Yeah. The age dependency ratio. So Keith, when you're old, like as such as yourself, you're not part of the labor force. And because people just haven't had enough kids and all the baby boomers have all the money and don't work, I would think you have a structurally tighter labor market. And that might delay this process for a while, but we'll see.
So, I know I'm getting older because I went and bought a new pair of like comfy walking shoes a couple of nights ago. And when you realize, you're like, oh man, I am getting old, because I was totally going for comfort instead of look and name brand and all that stuff. So I come home with them. I found a perfect pair. So yeah, these are great. They feel really nice. And I showed Mrs. Icecap, and the first thing she said was, they look like old man shoes.
What did you get?
The
New Balance?
No, they're not the New Balance ones. They're just a better shoes to wear.
Apparently, those are making a comeback. By the way,
they are made. They have.
They hold them long enough, they'll come back.
That's right. All my stuff is, it's no longer out of fashion. It's now retro.
You're in style.
Coming into play. Tell you what, though, for what I see, but Rich did a good job then. But the overriding theme with all the American data today was that none of it wasn't bad. Like, it was all okay. which again, it gives the Federal Reserve more confidence that, maybe if they want to hike again, they can do it. Whereas the rest of the world is getting some, pretty weak data. Earlier, a couple of days ago, I posted on Twitter the monthly, was it PMI or GDP data?
PMI.
Yeah, for
PMI
Canada.
manufacturing.
You want to read out the numbers, Steve? Do you have them in front of you?
Yeah, I do. So basically,
let's go from January all the way down.
Canada manufacturing. Keep in mind, as Rich will tell you, the 50s, anything north of 50 is expansionary. Anything south of that is obviously contractionary. So we started the year at 51, down to 52, or up to 52, and over the last, basically since April, so May, June, July, August, and September, it's all been in contractionary territory in Canada. So the latest number was the worst this year, 47.5 Canadian manufacturing PMI. So
it's going in the wrong direction, so to speak. So speaking of direction, we have a directionless, is that a word? Directionless.
Yes, that's a word.
Data point coming out on Friday. Steve calls it the random number generator, and it just so happens it is probably the most important economic data point out of Canada. So we're talking about the net change in employment for Canada coming out on Monday, and it's gonna move the market, big time.
What's the expectation? We should do a Twinkie bet on this.
I can't bet on that number because it's just pure guessing.
Yeah, it's great. It's like Russian roulette.
Yeah, it's perfect.
I think you actually know with Russian roulette you have odds to work with. With this here, you don't. It's just
you're just
close
a
your
chicken.
eyes and
you're a chicken, big chicken.
Well, I don't think I'm a chicken to bet on a data point. Okay, to set the tables, the previous month it was 40,000 new jobs. This Friday they're expecting 20,000. So what are you in for, Steve?
That's really bad. 20,000.
Yeah.
I think they need. What do they need, Rich? You tell me. I think it was like they need like 50,000 just to maintain current.
Well,
levels.
yeah, we can do the math really quickly. If there's a million people coming in a year, that's like, let's say 90,000 with a employment population of half that, of 50%, which is normal, by the way, before everybody gets up in arms. So you need about 50,000. Yeah, there you go. Well done. That's about $50,000 to keep people employed who come to this country.
Keith, you said 20,000.
Yeah, that's the estimate.
Oh man, I mean, I'll go over. Just because I think that number is way too low. They're setting the expectations low.
What do you have, Rich?
I'm just gonna start adding a negative to whatever number they expect. So I'm gonna say negative 20,000 is my guess.
Yeah, I'm gonna go minus 40. I will.
That'll get the bond market moving.
Yeah.
It might help the bond market though, actually. So if we get a negative print
for the Bank of Canada, yeah. So I think they're at the end of October 25th, I believe, is their rate hike. So they do basically. There's two big data points for the BOC to digest between now and then, and of course, it's the job numbers coming out this Friday, as Keith just talked about, and then I think we've got CPI. I think might be next week, but those are kind of the two last data points to potentially sway the BOC's decision.
It'll also be interesting for you, Steve. It'll also be interesting to see how many building permits come out, because next week you got building permits, you got manufacturing, a different type of manufacturing outlook. This one's from the BOC, and as you said, there's a CPI. But it'll be also interesting to see how many buildings are being built with the measures that have been implemented and counteracted by your boys there at the BC government.
I think those can be seasonally adjusted and annualized to kind of show, like, not, the best thing is, as Ben, who we had on the show, Ben Rabideau, said, look at building permits for single family, because the shorter duration of the construction timeline allows developers or builders to pivot really quickly to changing economic scenarios. Whereas, a building permit, for example, for an apartment building, because of the duration of the project, a lot of the times, you can't pivot as the economy starts to change. So if you're really looking for leading indicators, building permits on single family homes. But
cool.
Speaking of central banks, Keith, we had the BOJ, some updates in the BOJ, and then we had the RBA. So the RBA was out, I think it was yesterday. Anyways, they're still on pause. They've now held rates for 4 consecutive meetings. And so for all intents and purposes, I don't know if I want to say they're done, but it seems like they're done.
That's the Australians, everyone.
Yeah, RBA Australia. Yeah, which again, I would argue is pretty similar to Canada in the nature of, highly levered housing market, highly levered private sector, very sensitive to short-term interest rates, given the nature of their mortgage market.
And they're also heavily influenced by China as well. So when the Chinese economy is moving in one direction or the other, it has a huge impact on Australia. But then we have the Japanese. So the ninja in the room, is that we can?
No, Godzilla.
Yeah.
Somebody
Godzilla?
in the comments suggested Godzilla.
That's impressive, actually, because it's pretty hard to miss Godzilla if he was in the room.
It's like a panda, except cuter.
Yeah, because the ninja is quiet, right? You may not even see him there. It may not make sense. I like the Godzilla. So the Godzilla is that, Japanese are in this horrible predicament in that, the bond market is enormous because they've been borrowing in excess forever. And their currency is weakening at the same time. So they're trying to say, okay, what do we do here? Do we stop the currency or do we stop yields from rising? And like the bond market everywhere around the world, so rates are going higher everywhere. And I think people know by now, when rates are going higher, the price of bonds go lower. So with rates going higher, it's having a pretty big negative impact on the pension funds over there, as well as bank regulatory capital, you name it. So the Bank of Japan this week, everyone is waiting for them to do it. But they came out and they basically hinted, hey, we're going to stop the currency from falling and bond yields from rising. And immediately the Japanese yen, this was yesterday, I think, it immediately spiked 2%. So it appreciated by 2%.
Wow, that's a lot. I missed that.
Yeah, that's enormous. Yeah, that's a pretty big move. And then it came, I think at the end of the day, up me strengthened maybe 0.6%, I think. But some sucker got caught on the market trade order on that. I was watching live. I said, as soon as it happens, like something like that, the way my mind works is not like, oh, wow, that's a big spike. My mind works is, ooh, someone just lost their job. Anyway, but the Japanese, they spent, I think it was 6 or 7 billion to defend the currency. And it basically brought it back to where it was last Thursday.
You want to explain that to like the listeners listening? It's like, well, okay, they spend $6 billion defending the currency. How exactly do they do that? What's the sort of mechanism?
Yeah, so they sell US dollars that they hold, and then they buy yen on the open market. So it's like your supply demand story with housing market. It's the same thing on the currency side. So all of a sudden you have a big buyer coming in, it causes the price to spike higher and so forth. But
and what do they sell, Keith? And what do they sell?
Yeah, so to get US dollars, usually you're holding T-bills or T-bonds. So US Treasury bills or Treasury bonds. You have to sell that. So you need something liquid, and that's what people don't realize sometimes. Like liquidity, I think people are realizing it now, actually. Liquidity is incredibly important. When times are great, nobody values liquidity. But when all of a sudden, hey, times are tough, you need to sell something. You need to be able to sell something and to get your money immediately and not affect the price. So that's why I like I laugh all the time. The Chinese, they claim they have 3 trillion in FX reserves, and that ain't true. They might have about 800 billion, maybe 750 now. The other 2 trillion plus is in illiquid assets that they just cannot sell and get money for. So that's what was happening in Japan, and they didn't buy the bonds, by the way. So nobody could reconcile it this morning because everyone's trying to figure out what are the Japanese doing. But again, like here in Canada, we're talking about what's happening with rates, how is it affecting mortgages in the housing market and everything. The whole world is watching the Japanese as well, because if they put themselves in a position where they actually raise overnight rates, it could encourage a lot of Japanese money that is outside of Japan, to come back home, and that could cause a pretty big rush of capital out of everywhere else.
Japan raise rates seems unthinkable.
Unthinkable.
There's a couple of points I wanted to add just on the RBA. So one thing that we often talk about consumer confidence. So I just think it's like there's a positive and a negative for Australia. One is the consumer confidence numbers for Australia and New Zealand, because they're similar related economies, are just horrific. They're as bad as they were in the 1990s. So it's like a 30 year, I can't do math, 30-year low, which is really kind of incredible. Again, we talked about how their mortgage market is leveraged to the front end of the curve, and basically 90-something% of all of their mortgages were on variable going into this rate hike cycle. That number's fallen to like 60. So people are really getting dinged on that.
Canada, and by the way, for one people wondering, Canada's kind of around like the 30%, like the total market. Canada's kind of closer to 30 now. The very peak of the market, 57% of new originations in Canada were going variable in January of 2022 before the first rate hike.
Yeah, so that's why it jumped out at me.
Australia is nuts.
Well, that's what jumped out at me, because it's funny because, Keith joked about buying low and selling high. Well, the people in Australia are doing the opposite, and you sort of don't really blame them, right? Because they've got killed on this rising variable rate. And so they're trying desperate to lock in a rate now to sort of avoid any further pain. Problem is they're doing it sort of at the higher end of this rate hike cycle. We'll see what happens. But the other thing I want on the positive note for Australia is the CapEx cycle is restarting. So China's importing coal from Australia again, CapEx and centered around mining. So Australia is one of the largest producers of iron ore, coal. It's a third or fourth largest producer of copper. Aluminum bauxite, like you wouldn't believe it. Anyway, so they're starting to, that whole CapEx cycle is restarting. The problem is, will it be enough to sort of offset the pain on the household sector? Who knows? Similar thing in China, that there's some actually decent numbers coming out of that sort of manufacturing side.
But their carbon taxes, in China, that's really going to drag down investment as well.
What's going on with China coal imports?
China coal imports hit an all-time high. So I wrote a note about that, which I'm quite proud of. Basically saying, I'm quite positive on coal companies. You say, Rich, how is that possible? It's just that coal is an extremely, extremely useful product. And funnily enough, the higher and what's really cool is that you can turn coal into all kinds of hydrocarbon product, meaning you can turn coal, which is fossil fuels, and you can turn that into plastics and liquid fuel and synthetic fuel and all kinds of stuff. And the more expensive that the oil price gets, China has has built a lot of refining capacity. And through the process of coal liquefaction, you can import coal from Australia and turn it into fuel oils and diesel fuel and plastics and all kinds of product and sell it on to the rest of the world. So China's coal imports basically it peaked in 2022. It dipped a little bit, and now is right back up to all-time highs. And this is for consumption for electricity. Remember, folks, China built, I think, 50 gigawatts of new capacity last year. I think that's 6 times as much as every other country in the world combined. That's coal power plants. And as far as the total coal that they use consumption, it's by far and away the world's largest. So, I'm looking at the chart now, it's 25 relative to keep in mind the numbers, right? So, these numbers are ridiculous. It's about, 30 or 40% of all the coal basically consumed in the world is just China. And it's growing. Let's be very clear. That's the key bit.
Good thing we're crushing Canadian households with carbon taxes.
Yeah, it's such a joke. It's such a joke.
Well, that's
I really want to talk about that one day.
That one's for you, Mr. Gilbo there. He was also the guy that brought in that horrible bill for the podcasters.
Oh, yeah, C18. I actually think that might help us. I've said that before, but who knows? But the other thing on coal, just one more thing on coal, it's not just China. So, like, the second largest population in the world is India, some people might know. And India has made it explicitly clear in virtually like all their major economic development papers. So countries will write a paper saying, here's how we want to expand this industry, that industry. Here's how we want to make our population healthier, happier, richer, what have you. And basically one of their key pillars to this is access to a cheap electricity for everybody everywhere in India. Now, a lot of people in electricity are not rich. A lot of people in India are not poor or rich at all, and they need cheap access to cheap energy. And they're going to do this via coal. They've made absolutely no bones about it. Indonesia, also an enormously populous country, their coal consumption is absolutely ripping. And you'll love this, Keith. Do you know why? Because it is one of the major producers of nickel and a lot of other metals required for the green energy industry. So there's a
little bit of irony going on here,
just
don't you think?
Smidge of irony. I knew you'd love that.
Little, yeah.
So they're consuming gobs and gobs of coal to help in the process of refining all of the metals that you need in order to build the electric vehicles and the wind farms and blah, blah, blah. And it's just deliciously hilarious.
I mean, the other thing to point out, the amount of carbon being produced by Canada as percentage of global carbon production, it is going to decline.
It is falling rapidly, yeah.
Correct, but it has nothing to do with carbon taxes. It just has to do with the carbon being produced by China and India and everyone else. It's coming down as a percentage. It's good
Rich,
thing they don't have a podcast tax or registration.
Rich, what's the solution here?
Well, the solution is I think China is going to continue consuming an incredible amount of coal because it's useful, cheap, available, versatile. And most of the other emerging market countries in the world are going to absolutely follow that playbook. I mean, how really can you blame them? And in the West, we're going to turn ourselves into a pretzel, making ourselves poorer with no appreciable difference to global emissions at all. In the US, we talked about this a lot before. Natural gas killed coal, and exploiting natural gas resources, e.g. fracking, is what has cut down on US emissions. And I've said this repeatedly, and I'll say it one last time, and just to round out our second anniversary show, if Canada was serious about lowering global emissions, we would be fracking the bejesus out of our country and selling that natural gas to China so it could stop using that coal. But instead, we're going to do the exact opposite, which is great. So there you go.
You got windmills. They're killing all the whales. It's great on that. Boy. Just to wrap it up, if anyone's
did someone say wrap?
No, please.
Oh no, please.
By the way, what Rich just shared, then his viewpoint, I agree with it 100%. I think it's incredibly important, Rich. And I know you said, you said this before one last time. I want you to continue repeating this story as we keep going, because I think it is incredibly important for everyone. Go ahead, Steve. Sorry.
No, I would agree holistically. I think the one thing I would add to that, Rich, I know you're a pretty big proponent of their research, but for those that are interested in really understanding how, understanding global energy markets and sort of where we're going and how this is all going to play out and really cutting through the BS is Doomberg. I think Doomberg has done. So it's a Substack. It's a paid Substack. But they used to be on Twitter. I think they've solely focused on Substack, but it's a paid subscription. They're basically just denoting and researching and analyzing the global energy markets. And they've definitely debunked or questioned a lot of the so-called green energy transition. And again, it really, there's no political bias or views. It's just hard data. And I think it's a very, very valuable. If you got a few extra bucks kicking around, I would highly recommend it. Great reading.
So I got to jump on that too. So he also has pushed, and I think in an articulate and extremely well thought out way, nuclear power, which of course has been shunned in the West for some freaking unknown reason, as a way to basically make energy cheap and ubiquitous for everybody, blah, 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 at industrial scale. The other guy who, Steve, I think you'd really like is called Noah Smith. We're giving all kinds of free plugs. Maybe Keith should plug his webcast. But Noah Smith also really does a great job sort of detailing and outlining the energy transition, its feasibility, what's going to happen and where. And some of our politicians might not like what they have to write, but I would submit to you they're extremely unbiased and very, very well researched. So there you go. Those are. Oh. Should we round up? Keith, you want to give us you want to end the note on a plug for your
for the football score? Is that what we're doing?
Sure. Okay.
Okay, we go to every ending now. We do the football.
Yeah,
I think we have to
wrap it up.
Yeah, we're having a good season. Okay, this weekend it is the 4-0 San Francisco 49ers hosting the 3-1 Dallas Cowboys. I believe all time they're 19-19-1. I think it's something like that. It's been pretty even. So this game, it
You're
looks
going to be
close.
there, by the way. Keith will be live.
Yeah, I'll be there. I'll be there, so it'll be fun. But it looks to be close on paper, but both teams change a little bit every year. But Dallas has kept it close over the last 2 years, just because of special teams, miscues. So I get that cleaned up. So I have Dallas actually scored 16 points. I think that'll be good for them. And the hometown 49ers, 29, Rich. 29-16.
Keith, you almost nailed the last week's score. Do you remember that? You said 33-12 and it was 33-16 or something.
Yeah, it was pretty. It's hard to get these things sometimes, but it's a good bit of fun.
No, you're amazing. I was watching the game. I was like, oh my God, he's gonna do it.
50, anyways, look for Keith on the 50-yard line there at the upcoming game here. So
I'll be the guy streaking, in the middle of the field.
You're gonna really need your binoculars for that one. It's a good place to wrap it up. As always, appreciate the support. 2 years, and we'll see you next week.